you very much for joining us today, Rupert.
Pleasure.
So, the arrival of MiFID II looks set to affect the equities market more than any other one out there. But do you think the overall effect will be positive or negative in that space?
It's very difficult to say. So far, it's a draft document, and past experience shows that by the time it gets through the EU Parliament and various committees, who knows what it's going to look like in the final form. The bottom line should be, I dare say, extra cost, and it looks as though asset managers at this stage are going to be the ones affected most by it. Likely long-term effect could be that the custodians, like JP Morgan or State Street, would probably benefit from, I guess, a contraction brought about by the added costs that are being passed by the asset managers to their custodians.
Yeah, I think that there is a thing about the fact that it is still very much a draft, it is still proposals, but we've seen a lot of red faces very early on saying, I can't believe they're trying to push this through. But I think a lot of it won't get through. It will be a very different document once we come to the other side of the process.
Yeah, I mean, we've seen that in the US with things such as Dodd-Frank and various other means of, I guess, making the financial landscape safer. Whether they do in the end is another thing altogether.
So what areas of the proposals do you think will have the most radical effect?
I think quite possibly to do with custody, that the asset managers who are going to have extra costs with the increased reporting and compliance standards to provide more colour, if you will, on the more opaque parts of the market, such as derivatives, will be leaning heavily upon their custodians. So, companies such as JP Morgan or State Street or Citibank, the stronger ones will be able to adapt and consolidate their own positions as the smaller ones fall away.
Yeah, I think it interested me actually. There's been a talk for ages about the consolidated tape for Europe, yet there seems to have been a bit of a U-turn in the proposals that they're now saying, well, we want a consolidated tape, we want it privatised, so actually more than one company could end up providing that tape, which seems like it'll actually be the converse. And actually it'll be harder to pick out all the right information from one source. You'll end up with disparate information coming in from all different angles. I wonder if this is something that it sounds quite similar to the point you're making.
Yeah, absolutely.
So with the euro on the brink of collapse and countries' economies seemingly falling like dominoes, is now the right time to be pushing all the various new regulations through, or is that going to be putting extra demands on already very stretched financial institutions?
That's a very difficult one to answer. I mean, I would say in the first instance that we do not believe the euro is on the verge of collapse or anywhere near it. Although there are going to be some fundamental changes to the shape of the euro. Having regard to the desirability or the effects of new regulation, well, yeah, I think there are some areas that need to be looked at, and rather quickly. So, in terms of, say, bank liquidity, derivatives is another area, but other areas, regulation for regulation's sake, costs and so forth, one begins to wonder whether the added costs and the benefits, whether they are desirable.
Well, talking of added costs, I feel like I need some kind of horror movie crescendo to come in, but the Tobin tax is something that just seems it has so much opposition from so many sides. I can't see if there's any credible reason for it whatsoever, and I don't know if you've got what your opinions are on it, and if there is anything about it that could possibly work.
The Tobin tax, I think that Cameron was on the right track, and by rejecting it, it's a silly, ill-conceived notion based upon Keynesian thinking of the 1930s that some way of restricting speculation in the financial markets. The bottom line is that, as Barroso had said, that expecting to raise about 50 odd billion euro, that the banks had to give back to society. Well, quite frankly, that's nonsense, because the banks will simply pass the cost on to the end users, be they businesses or consumers. So it's an added tax. And personally, I'm wholeheartedly against it.
And even if they don't pass it on to the business and retail side, they'll just be scared away, surely, and you'll end up with banks pulling out, and you won't make anything like the kind of money they expect, because they'll simply just stop working in the areas affected by the tax.
Quite possibly, although then you've got the other problem of how would you differentiate between a speculative trade and natural business.
Actually, this is another thing that I've had a few people moot as a potential idea that's so similar, is the idea of the order cancellation tax, more in terms of reining in the speculation in the HFT space. That the idea that you've got so many people putting these fake orders in just to sort of force the markets in a given direction, and then cancelling them rather than actually going through with them, putting a tax on that, or rather a cancellation fee, might actually at least steady the markets a little, if not actually bring in a huge amount of extra money.
That sounds to me as though it's something that's well thought out and merits closer examination. My initial impression is that that's something that's come from within the industry, someone who's been in the markets, as opposed to an academic, a politician, or an economist.
So if we can just maybe move on to RDRs and the idea that IFAs need to have better qualifications. It seems on the face of it to be nothing but a very sensible idea, but it doesn't seem to be met with rousing applause from across the industry. So what are the primary concerns that you're hearing about, and what are your opinions?
We support RDR. It's a good initiative. Having regard to the lack of applause, well, I suppose turkeys don't vote for Christmas. That there's a lot of vested interest, particularly among the IFAs, and indeed for the fund managers who are paying them commission as a means of garnering support. We do have some concerns about the actual application and fairly strict guidelines of the FSA having regard to not grandfathering, which tends to overlook, say, someone who has 10, 20, 30 years experience in the market. It might seem unduly harsh. But no, overall, we're supportive of it.
So, from your observations, how much of an impact will the dissolution of the FSA and the powers reverting back to the Bank of England actually have in real terms?
I think it's a positive thing that the recent events, the GFC, highlighted some weaknesses within the FSA, and I suppose the guiding principle of light touch regulation, which has been shown to be deficient. The whole idea of having one super regulator, I think it's fair to say, has been a failure within the context of the UK. And the move back to the Bank of England, who are close to the market, particularly with regards to prudential regulation of the banks, makes perfect sense. Whereas the FSA can be more involved with consumer-facing, regulatory side aspects of the business, to which they'd be better suited.
Perhaps it's maybe the way it's been put out in the press, but I was actually under the impression that the FSA was disappearing completely from the picture, and in which case it seems almost like more of a rebadging of the FSA just to, well, now it's the Bank of England.
There is an element of that, but it's not disappearing altogether. It's just redefining or reallocating some of the responsibilities. So anything that's, say, to do with the wholesale markets, the banks, would shift quite rightly back to the Bank of England, whereas consumer matters, the retail investor, and regulation of retail advisors becomes a remit of the FSA, remains a remit of the FSA.
So if I can just ask you about HFT, it's often cited as one of the primary reasons for an increase in volatility and certainly helping to support the financial crisis, if that's the right way of putting it, at least by the press. Do you feel this is actually the case, or if this is scapegoatism? And should we be putting more stringent controls in place to try and steady this theoretically volatile trading arena?
I think a lot of it is nonsense. The GFC was caused by banks' reckless lending, full stop. To blame high-frequency trading is rather like trying to blame the hedge funds for short selling, weak banks in 2007, 2008. Or cast my mind back to 1987, the crash back then, that was blamed on program traders. That yes, these are part of the problem, but they're not the inherent cause.
Well, is it banks overlending, or is it banks being in a position where they can overlend in that sense by allowing those conditions to appear in the first place? There's definite huge rift now between the banks and the politics that allow them to continue, because there's a certain element of banks being so big that they are machines, that you can't really blame a bank for doing what it is there to do, which is make as much money as possible.
Well, yeah, that's a moot point. Having regard to what the banks do, say in the context of the events leading to the GFC, it wasn't just a systemic failure of the banks themselves and their own reckless, greedy, dishonest lending policies, but also it's an indictment on the regulators who are meant to oversee the bank, as we touched on earlier with the FSA.
Well, thank you very much for speaking with us today, but unfortunately that is all we have time for. So yes, I look forward to seeing you at Trade Tech, and if people want to find out more about Fat Profits, where can they go? www.fatprofits.co.uk. Fantastic, and if you want to find out more about the conference, it is of course www.tradetecheurope.com.